Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at Signature FD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. All right, we are back with another episode of the Vet Worthwhile podcast. My name is James Yost, joined as always by my co-host Travis York. Travis, how you doing, man?
Doing well this afternoon, James. How about yourself?
I'm doing great. Who are we talking to today?
We are real excited. We are very lucky to have Peter Kilkelly with Vet Real Estate here with us this afternoon. Peter, how's it going?
Doing well. How are you guys doing today?
Doing real well. It's real exciting to have you on. Excited to hear about all that's going on in your world. You and I have obviously spent a bunch of time together in the vet space, both kind of winding through the veterinary world, wearing a lot of different hats. So excited to hear about what you're doing now and how you're continuing to evolve the veterinary world.
It's been a great ride. Started about 18 years ago when I went to work for Brzezinski & Company, which is a CPA firm that works specifically with veterinary practice owners. And so there I had worked with owners, covering their accounting needs, their tax needs, and also the practice valuation needs. And then 9 years spent there. I then went and was the director of hospital acquisitions for VCA Animal Hospitals. And there I was responsible for acquiring their practices up and down the Atlantic seaboard. Spent 6 years there. And now I'm here with Vet Real Estate and going into my 4th year. And it's been really interesting and a great time here at Vet. We have something to the market that wasn't always in place or available, through my time.
I mean, that kind of seems like you're always out ahead. Like whatever's cutting edge, you find it, Peter.
Well, I don't know. It's more, I think it finds me, to be honest with you. But yeah, it's been a great 18 years, and I can't, speak highly enough. The pleasure it is to work with veterinarians and with practice owners, just really solid people, very smart people, and who what they have. They know the value of what they have, and so I love helping them, to maximize that value of their assets. So
no, that's great. I mean, that's we're aligned in that as well. Love the history that you have. Obviously, fantastic experience in different fields within the veterinary space. One of the things we want to get your take on is just how the landscape has evolved over your tenure, and like how is it different now than it was back when you first started? And that we can dive into a few different areas. So looking at practice sales with your experience with VCA, looking at the real estate and the vet hospital as separate assets, kind of what you're doing now. And then also any institutional demand that y'all are seeing and starting really in the veterinary real estate space. So why don't we go through that?
Sure. Yeah. From a practice sales standpoint, the landscape has changed greatly. Back when I first started valuing practices, most of those valuations were done for the purpose of an associate buy-in. Maybe 10% of practice sales we saw were to a corporate consolidator. But most of the activity was really driven or stayed in-house between, owner and associate. And then, as we can see today, it's completely flipped around where now consolidation has a majority, if not, 90% of the practice sales that occur around the country. And so with that, I think some of the changes is that, previously it was the owners looking to retire is what drove the purpose of the sale. I think with the increase in multiples and values of practices, a lot of the purpose for the sale was less on retirement and a piece of it became more about just capitalizing on a value. And so I think what we found was a lot of actually younger practice owners selling their practices when they're in their mid to late 40s and 50s, when 10, 15 years ago, your average age of your seller was, 60, 65. And on the real estate side, the building was never really thought too much about, 18 years ago. It was, I'm selling my practice, I'm going to hold on to my building, I'm going to collect the rent, and that was about it. It wasn't really much of a thought process to it. And I think the reason why is because there wasn't a easy transition for property owners in that time to exit out of ownership. But today, exiting from property ownership is much easier due to the demand for buildings and to the increase in institutional buyers out there right now. And again, 15 years ago, there was pretty much little to no institutional buyers out there, targeting veterinary real estate. And now today, again, we have several different types of investors, whether it's groups with a fund or a REIT like TerraVet, or it's a 1031 exchange buyer who's looking to exit out of one investment property and looking to get into another one. And in doing so, they're looking at the veterinary space as a way for them to transition between investment properties.
Yeah, I mean, I think it's real interesting, right? I mean, Peter, you and I have both been around the veterinary space now for an extended period of time, but just the recent rapid evolution. I mean, to what I was joking about earlier, you're always on the cutting edge, but 4 years ago, there really was no focus on the real estate as a separate asset or a separate, exit strategy or financial planning strategy. And so I guess, before we kind of start diving into how you're changing the world now, maybe best place to start is just, what's the history of the veterinary real estate? I mean, I think back to, what you said, that sold at fair market value to another veterinarian, or even if I go back a generation before that, a lot of these hospital pieces of real estate were sold to Walmart so that they could develop a Walmart on the edge of town, because all of the veterinary hospitals were outside the city limits. And, a lot of people made a fortune there. But, it's interesting to see how the market is so different today than what it used to be. And I'd love for you to, just kind of share with our listeners what they need to understand about how real estate is valued today and how they should think about that.
Yeah, I got to say the biggest thing for veterinary landlords to know and understand is the impact that the lease they have has on their property value. When you have a long-term lease in place with a tenant, the lease becomes the value driver for that property. So practices, right, are valued based on the annual cash flow they generate. Well, real estate, when you have a long-term lease in place, is valued the same way. So the rental income that is generated by that lease agreement is the significant value driver for the real estate. So it's important for landlords to know that. And when they're talking about the lease or they're negotiation selling their practice and they're getting into a lease, they need to understand, what terms add value to the property to ensure they get them in the lease. I think historically, an issue is that the lease was never really, mentioned or discussed. And so through the course of a practice sale, the majority of the attention was put on agreement, the non-compete agreement for the owner, and then the employment contract for the owner. And then the fourth agreement was the lease agreement. And having gone through these processes for many years, you always got the sense that everybody kind of, suffered the brain damage through the first three. And by the time they got to the lease agreement, there just wasn't any gas left in the tank. And more often than not, the lease agreement was just looked at and said, hey, looks like it makes sense. I got my rent. I'm getting, 5 years. Okay, sign it and move on. Where now we're kind of putting the brakes on that, thought. And I'm kind of up on the mountaintop screaming down saying, everyone, it's important for you to make sure you look at that lease agreement, because if you don't, you're going to realize that when you do decide to exit, you could be leaving some money on the table in terms of the value of your real estate.
Yeah, let's dig into that a bit. I mean, we spend a ton of time sitting down with folks who are considering the exit of their business, of their practice. And every single time, just like you're saying, I mean, they're also going to be negotiating a lease and how that falls down in the pecking order. What are a few things that you think we should be focusing on? What are some things that the practice owner should be focused on when they're looking at their lease? And what are like some of the common things that maybe they're missing when they're focused on the other, the rest of the deal, so to speak?
Yeah, I think it's very important to understand, who's the tenant on paper or as stated in the lease agreement. right? Many, when you're selling to a consolidator, more often than not, most consolidators have a subsidiary that gets formed either for the purpose of buying the assets of the practice, or they might have one already formed that holds the assets of other practices, maybe that they purchased, in the state that you're in. So it's very important to understand who the tenant is, because there's a difference, and this difference is going to affect the value of the lease, whether that tenant listed is the subsidiary or if it's the parent company. And as a landlord, you're going to want your lease with the parent company. And as an institutional investor such as us, we are going to look more favorable on a lease that has the parent company as the guarantor of those lease terms. Another thing too, which gets overlooked a lot, is how do you set your rent and what's an appropriate rent level? Many people, because they own both the practice and the real estate, together, right? You're the sole owner of both. The rent hasn't been, determined, based on market factors, right? It's either I had a loan at one time and this met my debt obligation, or for tax purposes, I'm setting it at this, or it's, hey, this is what I want to pay myself and I'm going to pay X. So it's very important to kind of understand why your current rent is what it is, and to know, is it set within your current or area market rent? And if it's not, it's important to make sure you set it within that rent range.
Hang on here for a second, Peter. Like you just blew my mind. I thought all the benchmark studies told us that rent was just supposed to be 5% of revenue.
I'm so happy you just brought that up, Travis. So the benchmarks are good, right? They give us kind of a range of where we should be. However, the benchmark on its own is not enough. And it's very important when you're looking at rent that you do understand actually what is the going, price per square foot on a triple net basis for commercial real estate in my area. Ideally, if that's set appropriately, you should find yourself falling within those benchmark ranges of 5 to 7% in most situations. But to rely solely on those, I've seen a lot of lease agreements where practices were either outside of the rent range, whether either being very high or too low. So again, it's a great metric to have, but it's not the only metric when you're looking to set rent.
So for a long time, just how surprised are they surprised, some hospital owners, when they go through this process? They're focused on the value of their practice, and then, come to find out that they're going to be also selling their practice real estate for several $1 million. Is that usually a surprise to these owners, or is that something that they've usually come to expect?
No, it's different, because it's actually not always, a premium value. Because there's so many different pockets around the country, right, where development is outpacing, other areas. And quite frankly, there's places because of that development where the dirt's worth more than what the lease is providing for value for the property. So that's the other thing, is to really understand, kind of where you fall in that range with your rent. And so, you will find owners who, I thought this property was worth 1.1 million, but the lease I have, the way I negotiated, I got all these great terms. I have a really good, rent set within my market range, and I'm seeing offers for $1.82 million. Right. Where on the flip side of that, there's practice owners saying, hey, I'm in the heart of Nashville, Tennessee, right? And price per square foot here is $45. My building should be worth $5 million. The problem is that they got into a lease agreement where the rent's set at $19 a square foot, right?
Yep.
And so your property is worth, we'll call it $3 million. And so there's a huge gap between the expectation and the reality. And so that's why it's really important to look at that rent. Because the other, thing, you can only do this once, and you can only negotiate the lease at one time. And so you can't go back and renegotiate it. So You always want to make sure that, again, the appropriate amount of time is put into looking at that lease and ensuring that you do have an appropriate rent. And I've talked to a lot of practice owners, especially over the last couple of years, who are saying, well, I took a haircut on the rent because I knew I was going to have an increase in cash flow for the practice and I was going to get more money, on the practice side. And I get it. I'm not going to argue against that strategy. But you do need to realize that what you did there is that you just took some of the real estate value and you're getting it out of the practice.
Mm-hmm.
Right. So when you do go down later, down the road and you decide to sell the real estate and you're expecting 5 million and somebody comes back and you're seeing, offers at 4, you need to realize that you already took $1 million off the table, a couple of years ago when you sold the practice because you settled on that below market rent number.
Well, you just bring up a great point there, Peter, that I think oftentimes forget that, gets just missed because the veterinary world has been so focused on fair market value, what it compares to if you compare it to what other properties in the community sell for, really not looking at the lease at all. That once you enter in that lease, you've kind of fixed the value of your property. Obviously, market conditions can, move slightly and how much somebody's willing to pay for that lease. But really, at that point in time, what you have is the value of the lease, not what somebody else may look at the property and say it's worth.
Yeah, that's correct. So that's, you are marrying your, to your tenant. And you're, with a 10-year term, you are legally obligated to provide that space to your tenant for the next 10 years.
And those options add on too, right? Because the options give them a way out and you an obligation. So, that can be a 15 or a 20-year commitment.
Correct. So if you're in one of these, rapidly developing areas and you're seeing, hey, my, friend down the street had a parcel here, they had no tenant, developer came in and, paid, $500 a square foot for the parcel. And I'm expecting the same thing on mine. But the difference is that he didn't have a lease in place. There was no tenant in that property. And that developer paid that because they're taking what was once maybe a single tenant commercial space and they're redeveloping it into a multi-tenant commercial space that's going to be generating, 2 to 3 times the rent that was originally, being generated there. Right. Where you are, again, you're tied back into that rent right there and you're committed. So you don't have the luxury of being able to sell that parcel to a developer, at a premium value because you're obligated to provide that space to your tenant. So.
No, what's been so interesting to me, throughout kind of our discussion here is just this evolution and how you have to start to think about, the real estate differently and how you think about assessing value and assessing a lease. The evolution, do you see that, are we kind of at the pinnacle of that and what's going to happen in veterinary real estate is here? And if I own veterinary real estate, I don't need to think about it anymore if I learn what's going on now, or do you see the world continuing to evolve around veterinary real estate?
Well, yeah, I think, I think as our world, everything's evolving, right? I don't think no matter what factor of society or industry you look at, there's always some sort of evolution going on. And so the veterinary real estate market's no different. TerraVet back in July launched what is called the TerraVet REIT. And so that is a nice real estate investment trust opportunity for veterinary property owners to, in lieu of selling their property in exchange for cash, this gives them an opportunity to contribute their property and the value on a tax deferred basis into our REIT structure in exchange for shares of the REIT. And so not only does it give them some tax benefits, it also still provides them cash liquidity similar to what they're receiving today in rental income through the dividend payment they would receive as a shareholder. So that's a structure that's really starting to come on and is looking to be more attractive.
That's great. And I think we could probably spend some time going deeper in that. I mean, one of the things that we want to do, in addition to the podcast recordings, is some educational content. So maybe the three of us will come back and do a 10-minute snippet on what the REIT is, how it's structured, maybe get a little bit more into the technical details. Is that something you'd be interested in doing, Peter?
Yeah, definitely.
Love it. So, Peter, obviously, this has been a crazy year for a lot of different asset classes. We've seen interest rates come up quite a bit. How does that have an impact on the work y'all do and on the assets that y'all are trying to acquire?
Yeah, interest rates have a direct effect on the capitalization rate, which is used to determine value property or the property value. And so, yeah, much like how interest rates have climbed, cap rates naturally have increased as well. And to understand cap rates, it's important to know that as cap rates go up, property value goes down. So it doesn't work the same way as multiples, where if you get a higher multiple, you get a higher value. You don't want cap rates to go up to maximize value. You want to try to keep them as low.
Understood. Hey, fair is fair. So we want to throw a couple different scenarios at you to see how you would advise different types of people. Some of our listeners are at very different stages of their careers. So how would you advise somebody who owns the practice and the real estate today?
Yeah, I would, again, make sure you have a lease agreement in place, even if it's just with yourself. If you own both the practice and the real estate 100%, it's still important to have that lease in place. It spells out what the responsibilities are for tenant and for landlord. It's also important too, because again, if you're selling your practice, you're going to be valued on that cash flow. And if you are paying all of the expenses related to the building from the cash flow of the hospital, which is pretty standard, you want the lease to show that. And you also want it that way. So that way, whoever the next buyer is of the practice, they're going to be continuing to treat it the same way. And so then that way, when you look at your rental income that you will eventually start to receive from the new tenant, you want to make sure you don't have additional expenses that have to go against that rental income that used to be an expense of the practice when you owned it.
Gotcha. So what about if someone's considering or in the process of selling to a corporate buyer? What are some of the things they need to focus on in their lease? You already talked about a few with the corporate guarantee, but like when thinking about lease term and landlord responsibilities, things like that, how would you advise them on those items?
Yeah, you want to make sure you have a really clear understanding, on the lease terms as they're spelled out in the lease that's being presented to you. So yeah, again, corporate guarantee, you want the landlord responsibilities to be as minimal as possible. The tenant should really have the responsibility to pay for the upkeep of the facility, both repairing and replacing the components of the building. Another term that gets overlooked is that can be a right of first offer or a right of first refusal in leases. If you're the property owner, you don't want to be tied back down to or be prevented from taking your real estate to the market freely. And what a right of first offer or right of first refusal does, it kind of blocks you from that opportunity. So definitely recommend removing that language from any lease agreement you sign. When you do decide to sell the property, again, you want to be able to take it out to the market and get bidders on it and sell it to the buyer of your choice.
So one question I was going to ask is kind of a follow-up on that, right? Like, we're in the weeds of negotiating this, and I know you've given, a couple of people that I know some advice that, hey, make sure to negotiate those terms in the LOI, talk about them early on so you know what to expect. But then when you're doing that, Peter, are there, you can only, like kind of using that little saying, there's only so many hills you can die on. Are there a couple of things that you view as like really critical that you don't give on? Is the whole lease mission critical to not give on? Any insight there for people to think about?
Yeah, I think without a doubt, the corporate guarantee and understanding who the tenant is, and making sure the parent corporation is is listed either as the tenant or there's what is called a guarantor letter attached to the lease is mandatory. Ensuring you got at least 10 years in your initial term is extremely important. I wouldn't budge off of that. The languages are constantly evolving, right? Get back to that, statement earlier about everything's evolving, and these lease agreements are evolving as well too. And actually, I saw a new clause in a lease agreement just yesterday that I'd never seen before that really kind of grabbed my attention. And so, again, I think is if you could focus on about, the 5 strong terms that are going to drive value for your lease, and you stay committed to those, I think you'll end up with a very strong and marketable lease and property when you're all said and done.
Excellent. Well, let's just say I'm one of those sellers who have negotiated correctly, sought out the right advice, and I currently hold a really strong corporate lease. What would you suggest for those veterinarians who maybe have a lease in place today? What should they be doing and what should they be thinking about?
Sure. I think the first thing is just to understand, how a lease is valued, right? And with that is the longer the time left on the lease is going to be reflected in a higher value for you. So what I mean by that is you got a fresh 10-year term lease. That lease is going to be maximizing its value in the first, I'd say, 1 to 2 years of it. As the lease gets older and you start trickle down from the 10 years down to 5 years or 4 years left on the lease, that's going to negatively impact the value. So anybody who's sitting there today, who's signed a lease agreement, I definitely recommend that they go out and find out what it's worth. Understand where your value is today, even if you're not interested in selling it, because then you can at least get a sense, okay, if it's worth $2 million today and I sit on it for the next 6 years, probably is not going to be worth $2 million in 6 years. And it's, probably going to be less. So you need kind of a heads up on that. The other thing too, again, is where interest rates are and cap rates, it's always important just to stay kind of, aware of where the market is, right? We talked to practice owners over the last few years, and there were practice owners that had no interest in selling. And then all of a sudden they just got an offer they couldn't say no to, and it made sense financially for them. So I always think when you have assets like this, it's important to kind of stay on the forefront and understand where the value is. So that way you can make, a decision that truly ends up maximizing the value of that asset.
One of the things we really wanted to catch up with you on, Peter, and this really came from when we were all sitting around the table at Western having this very same conversation. The market has changed quite a bit since then. I think that was February of this year. But what is your current take on the consolidation market? I mean, how would you kind of share some insights with our listeners?
Yeah, sure. Yeah, unfortunately, practice values have come down a bit over the past few months. Multiples have dropped. When we started off talking earlier, I mentioned that, most practice sales were driven by owners' desire to retire, right? But then as practice values increased over the last 5 years, the type of seller, really started to change. It went from that veterinarian who was really just looking to retire and exit to veterinarians who were much younger, still had, 10, 15 years left of, or desire to work. But I think now as the multiples are dropping and these values are dropping, I think that pool of buyers is going to swing back to where we were 15 years ago. And so I think you're going to find less interested owners selling, and ones that are in the market to sell. Again, I think the purpose really is that they're just ready to retire and ready to move on.
No, I mean, I think I'm definitely seeing that. And even just in the conversations that I'm out having with people, Peter, it's, it doesn't make sense, or it's difficult now for a 45-year-old veterinarian to think about that sale. But how do you see, kind of this shift in timing of sales impacting how the people who sell think about their real estate? And, what does that do to the real estate values, and what happens with veterinary real estate over the next 5 to 7 years?
Well, I think it actually might become or play more or get more attention, right, than it has. Because I think, for practice owners who had a set value in their mind, they go to sell their practice. And if they don't get it, they may look at the real estate as an option that will kind of bridge them to get to that cash value they were looking for. So, examples, if they were hoping to sell their practice for 10 million, but they were only getting 8, but now if they sell their real estate and along with the practice, that'll give them their 10. I think you're going to find that type of buyer out there. Also, I just think if more of the buyers are really individuals who are looking to retire, I also think that's, going to, drive some of the real estate sales too, because, we have different types of sellers on the real estate side. We have ones that are selling the practice. They're kind of just want to be done with everything. So they want to sell the real estate at the same time. We have other ones that are selling the practice, but they want to stay on and continue to work for a couple of years. And in doing so, they're just going to hold on to the real estate and collect the rental income. But 2 years down the road comes, and now they're, officially stepping away. Then that becomes the time for them to, okay, now I'm going to exit the real estate, because quite frankly, I'm not in the building on a daily basis like I used to be. And I don't want to be bothered, with owning this anymore. And then you have the other ones who, live in one part of the country, and then they sold their practice and they've retired and they've moved to a different part of the country, and they don't want to own this asset that's, a 3-4 hour plane ride from them anymore. So I think if your pool of buyers are more retirement focused, I think it's just going to, reflect positively on the real estate side.
No, that's great. That's super helpful. Definitely gives us and our listeners a lot to think about. I mean, we're going to kind of start wrapping up here. It's been awesome catching up with you, Peter. I took 3 main takeaways from this conversation. The first is how important and impactful the lease terms are on value, even relative to things like location and quality of the building, just the importance of having those lease terms. Also, second point is making sure that the details are negotiated at your best advantage on the front end. So some of the key terms you went through, that was great. And then lastly, it's a dynamic market. So checking in with somebody like yourself, who's a specialist who understands how the value evolves over time, super important for the building owner. So thanks again for coming on, Peter. If someone wants to get in contact with you, what's the best way to reach you?
Yeah, feel free to reach out to me via email. My address is peter.kilkelly@terravetrealestate.com, or feel free to check out terravetrealestate.com, our website. Click on the contact us or evaluation buttons on our website, and you'll get linked right back to me. So those are probably the easiest ways to get in touch with me.
Awesome. Well, this has been great and incredibly enjoyable, Peter. I mean, just immense amount of insight for all of our listeners. There is a little saying that hangs up in the bathroom that says everyone wants to change the world, but no one wants to change the toilet paper. So, we always conclude the episode and ask our guest, have you ever snuck out of the bathroom without changing an empty toilet paper roll?
I guess. I'm sure at some point. Yeah.
Only the public restroom.
Yeah, without a doubt, public restroom. But yeah, I'm sure at some point in my own personal house, yeah, that's happened.
Well,
I think I'd be lying if I said no, never.
At least you're honest. We've had a couple of people who have gotten called out by spouses on whether they changed the paper roll or not. Now, just on as we conclude, one piece of serious advice, since we answered the change the toilet paper roll. Do you have a piece of advice for a veterinarian or somebody in the veterinary world that does want to change the veterinary world?
Yeah, what I think is really cool. And again, kind of getting back to a term you used earlier, the evolution. And I think the evolution of the industry, what it's done is, 30 years ago, most veterinarians, they practiced and then they retired. And I think what's happened the last decade is that there's been a lot of more opportunities for veterinarians in different parts of the industry. And so, you're constantly meeting individuals who have been former practice owners. They've worked for consolidators. They've done development. The same people have gone on and worked, for manufacturing or distribution. And so they've worn so many hats over their careers. So my advice to any veterinarian who's looking to, change the veterinary business world is to seek out individuals who have these different types of experiences. And you'll be amazed. I was just talking to one veterinarian this morning. He's touched on 5 different segments of the industry where he's been very successful. And so when you think about that and the resources and just, the advice that he could share, it's invaluable. So that's my recommendation is to talk to people, take your ideas, bounce it off others. Because there's so many people out there with these great experiences that could really help guide you in that path.
Love it. People helping people.
There you go.
That's the right way to do it. Awesome. Well, this has been the Vet Worthwhile podcast by Signature FD, James Yost and Travis York. Peter Kilkelly, it was great having you from TerraVet Real Estate. Thanks to all the listeners. We'll see you next time.
Gentlemen, it's a pleasure as always. Thank you.
Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signature veterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of Signature FD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which Signature FD has no involvement or ownership. James Yost is a partner and wealth advisor at Signature FD. Signature FD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and Signature FD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.